The roof went in the middle of a February thaw. 24 units in Dayton, Ohio, built in 1968, and water running down the inside of the north stairwell. The repair came to $61,400. That building had cleared $26,260 in cash the year before. So one section of roof erased 28 months of profit. The owner still wired his loan payment on the first. He always does. And that number never appears in the spreadsheet people build before they buy. An apartment complex is one of the few assets where a stranger pays down your debt while you sleep. It is also one of the few where a single February can undo 2 good years. Buy 24 units in a soft Midwestern market, and you are signing for somewhere between $1.3 and $1.7 million. You will need about $600,000 in cash to make that happen. In exchange, you get roughly $2,188 a month in real spendable money. That works out to $91 per unit per month. $91. For that, you accept phone calls at 4 a.m., a bank with a 7-year clock on it, and an insurance market that reprices you every 12 months. So the question is not whether the rent comes in. The question is what the rent has to survive before any of it reaches you. Almost everyone gets the asset wrong on day one. They think they are buying a building whose value follows the housing market. It does not. A single-family house is priced by what the neighbors sold for. A 24-unit building is priced by its own income statement and nothing else. An appraiser takes your net operating income and divides it by whatever return buyers in that submarket demand that quarter. That divisor is the cap rate. At a 7.6 cap, every extra dollar of annual income you create adds about $13 to what the building is worth. Find $400 a month in laundry money, and you have manufactured $63,000 of value. Let one tenant stop paying and you have destroyed it. This is why 2 buildings on the same street can trade 11 months apart at prices $300,000 apart. Nothing about the bricks changed. The rent roll did. Money comes in from tenants and from everything you can legally bill them for beyond shelter. Money leaves through the county, the insurer, the bank, and the maintenance van. The county and the insurer are the 2 that will surprise you, and they are the 2 you cannot fire. Before any of that, you have to get the keys. Plan on $600,000 of cash to close on a $1,420,000 building. That is $59,167 per door in a market like Dayton or Toledo. The down payment is the first bite. Commercial lenders on small multifamily want 25 to 30%, so call it $426,000. Closing costs on this size deal run near $44,000, and they are not the costs you know from buying a house. A commercial appraisal is $4,800, not $600. The lender orders a Phase 1 environmental report at $2,900. Then a property condition assessment at $3,400, which is an engineer telling you the roof has 4 years left. Add title work, transfer tax, a real estate attorney at $2,900, and prepaid escrows for taxes and insurance. Then the units. 8 of the 24 will be rough because the seller stopped turning them the day he listed. Budget $9,400 each for flooring, paint, a cabinet run, and appliances. That is $75,200 before a single new lease is signed. Your bank will also hold 6 months of debt service in a reserve account, roughly $40,030, and it is not yours to touch. Keep another $14,000 liquid, or the first burst supply line will be paid with a credit card. The lean version of this deal exists. 16 units in Youngstown at $38,000 a door, seller carrying part of the paper, and you are in for $310,000. The realistic version is the $600,000 above. The heavy version is 32 units in Greenville, South Carolina at $148,000 a door, where you write a check for $1.6 million and accept a 5.2% return for the privilege of owning in a growth market. None of those numbers include the part of this business that is measured in months rather than dollars. The paperwork will cost you less than $6,000 and more time than you think. Form the entity for about $900, then a separate one if the lender wants a single asset borrower, which it usually does. Most cities now require an annual rental registration on every unit. Cincinnati, Minneapolis, and Kansas City all run some version of it, and fees land between $30 and $95 per unit per year. Registration triggers inspection. An inspector walks all 24 units, writes up handrails, smoke detectors, egress windows, and cracked outlets, and gives you 30 to 60 days. Fail twice, and some cities escalate you to a tier that requires inspection every year instead of every 3. Anything built before 1978 pulls you into federal lead paint rules. Your contractors need EPA renovation certification at $300 a head, and a single unreported disturbance of lead paint carries fines in the tens of thousands. Have an attorney rewrite the seller's lease rather than inheriting it. That is $2,400, and it is the cheapest insurance in this business. From accepted offer to keys is 60 to 90 days on commercial debt. From keys to a clean certificate of occupancy on every unit is another 8 to 14 weeks, which means your first 4 months of ownership can be almost entirely expense. And where you decided to spend that money matters more than any of it. Nobody leases an apartment building, so the buy versus lease question turns into something else here. It turns into a master lease, where you pay a fixed monthly amount to control a building you do not own and keep the spread on the rents. It looks brilliant on paper, and it fails in exactly one place. The moment a $14,000 sewer line breaks, you find out the agreement never really said who pays. Own the thing or walk. Price per door tells you which country you are operating in. $59,000 in Dayton, $112,000 in Indianapolis, $210,000 in Raleigh, $486,000 in Denver. The Denver building has better tenants and almost no cash flow. The Dayton building has cash flow and collection problems. Choose which problem you are equipped to run. The wrong submarket does not kill you through vacancy, which is what everyone watches. It kills you through collections, which almost nobody models. Two buildings can both show 95% physically occupied. In one, 98.1% of the billed rent actually arrives. In the other, 84% arrives, because 6 households are 3 weeks behind at any given moment, and 2 are gone entirely. That gap is $39,000 a year on a rent roll this size. It is also $500,000 of value at a 7.6 cap. Pull the county court records for eviction filings within a mile before you offer. Pull the tax delinquency list too. Those 2 documents will tell you more than any population growth chart. Once you have the right box, you have to make the inside of it work. An apartment building is a machine, and machines have parts with prices. Start with the unit turn, because you will do 6 to 9 of them a year forever. Luxury vinyl plank runs $3.10 a square foot installed, so $2,170 for a 700 square foot 1-bedroom. 2 coats of Sherwin-Williams Promar 200 across that unit is $640 in labor and material. A Whirlpool 30-inch range is $649, a matching fridge 8 modern 19, and a Rheem 40-gallon water heater 1,250 installed. A basic kitchen cabinet run with a laminate top is $1,050. Add $380 for a keyless lock and a rekey. That is your $9,400 turn, and it takes 9 to 17 days if your vendor answers the phone. Now the building systems, which are where the real money hides. A 1968 property probably has 1 master water meter, which means you are buying every shower any tenant takes. Submetering all 24 units is $640 a unit and pays back in about 20 months. Individual gas furnaces cost $4,900 to $6,800 each installed, and you will replace 2 or 3 a year on a building this age. A train condenser and coil for a 2-bedroom is $6,800. A new flat roof across 14,000 square feet is $126,000, and the engineer already told you the clock is at 4 years. Parking lot seal and stripe is $8,400 every 6 years. 2 commercial washers and 2 dryers with a card reader run $11,600, or you let Wash install them free and keep only half the revenue. Then software, which everybody forgets. AppFolio charges roughly $1.65 per unit per month with a $298 monthly minimum, so you pay the minimum until you own 90 units. That is $3,576 a year to collect rent online, screen applicants, and produce the reports your lender demands every quarter. All of it still needs someone to actually swing a wrench. 24 units cannot support a single full-time employee, and that is the awkward truth of this size. It is too big for you and too small for a team, so you assemble one out of pieces. A third-party management company will run the building for 5 to 7% of collected income, not the 10% people quote from single-family rentals. On this property that is about $16,400 a year. They will also charge a leasing fee of $400 or half a month's rent every time they place a tenant, which is another $2,800 across 7 turns. And they mark up outside vendors 10 to 20%. So your $14,000 sewer repair invoices at $16,100. You want a part-time maintenance technician at $24 an hour, 15 hours a week. That is $18,720 in wages, plus payroll taxes and workers' compensation insurance at roughly 14%, which is where people under budget. A porter for 9 hours a week at $17 handles trash, snow in the lobby, and costs $7,160 loaded. Then the specialist you keep on speed dial. A licensed plumber bills $165 an hour with a 2-hour minimum after 6 p.m. CPA who actually understands cost segregation and passive. Activity Rules charges $3,200 for the return. Added up, and management plus payroll plus leasing runs about 13.4% of your effective income. That number is worth memorizing, because every seller pro forma you read will show it at 8%. Payroll is also the only line you can genuinely control. The rest of the monthly outflow arrives whether you answer the phone or not. Here is the burn per year on the whole property. Property taxes are $33,900, and this is the line that ruins first-year projections. The county reassesses on sale. The seller was paying $19,400 on a stale 1994 valuation, and the day your deed records, the auditor picks up your purchase price and adjusts to it. Nobody tells you that at closing. Insurance is $21,800 or $908 a door, and it was $14,200 3 years ago. You need a commercial package policy with general liability, not a landlord policy scaled up. Water and sewer on a master meter is $19,600. Common area electric and gas for hallways, laundry, and the boiler pilot is $8,900. Repairs and materials separate from turns run $15,800. Turnover across 7 or 8 units is $11,600. Trash is $4,080. Lawn and snow $5,400. Administrative, software, licenses, and legal come to $6,300. Management is the $16,400 from earlier. Payroll is $14,200 loaded. And then the line every amateur deletes, which is a capital reserve of $300 per unit per year, or $7,200. That reserve is not maintenance. Maintenance is the leaking faucet. The reserve is the roof, the parking lot, and the furnaces, and the fact that all three have a known expiration date. Total operating cost is $165,180 a year, or $13,765 a month. Add debt service of $81,660, and this building consumes $20,570 every month before you keep a dollar. So the only question left is where $20,570 a month actually comes from. Rent is the engine, and it is more granular than a single average. 6 studios at $745, 14 one-bedrooms at $895, 4 two-bedrooms at $1,145. That is $21,580 a month of gross potential, or $258,960 a year, assuming every unit is full and everyone pays. Neither of those things is ever true. But rent is only the part of the income statement your competition thinks about. The operators who beat the market build 4 or 5 layers on top of it. Utility recovery is the first and largest. On a master-metered building, you can bill water and sewer back to tenants by a formula based on unit size and occupant count. Recover $44 a unit per month, and that is $12,672 a year against a $19,600 bill. Consumption drops 7 to 12% the month it starts, because people fix their own running toilets when they pay for them. Laundry is next. 2 washers and 2 dryers at $350 a cycle in a 24-unit building nets about $430 a month if you own the machines outright. That is $5,160 a year, and remember, it is also $68,000 of appraised value. Then parking, which most Midwestern owners give away for free out of habit. 14 assigned spaces behind a locked gate at $35 a month is $5,180 a year. Basement storage lockers built out of $2,400 of framing and mesh rent for $28 each. 9 of them is $3,024 annually, which pays back the build in 10 months. Pet rent at $40 a month on the 22 animals already living in your building is $10,560 a year. They are already there. You are simply not being paid for them. Application fees at $45 across 60 applications recover your screening costs and then some. A month-to-month premium of $75 converts your riskiest tenants into your highest-paying ones. Now, the 2 revenue streams almost nobody outside this business knows exist. The first is your roof. A rooftop antenna lease with Verizon or a Crown Castle-style tower company pays $900 to $2,400 a month on the right building near the right highway. That single lease can be worth more than 4 occupied studios, and it requires no maintenance whatsoever. The second is your local housing authority. In a soft submarket, a Section 8 payment standard can sit $90 to $180 above your market rent, and the government portion arrives on the first of every month by direct deposit, recession, or not. Operators who sneer at that program are usually the ones with collection problems. Total ancillary income here is about $37,200 a year, or 12.6% of the top line, which means the moment you finally add everything together, the picture is nothing like the one in the seller's brochure. Total potential income is $296,160. Now subtract reality. Vacancy at 6.2% takes $16,056, Bad debt at 1.9% takes $4,920, and concessions take $2,100. Effective gross income is $273,084. Take out the $165,180 of operating cost, and net operating income is $107,904. That is a 60.5% expense ratio, which is normal for a 1968 building where you pay the water. Anybody showing you 42% on a property this old is showing you a fantasy. Divide that income by the $1,420,000 price, and you own a 7.6 cap. The bank lends $994,000 at 6.65% on a 25-year amortization, so debt service is $81,660. Your coverage ratio is 1.32, which clears the 1.25 minimum with almost nothing to spare. Cash flow is $26,244 a year. On $600,000 of invested cash, that is a 4.4% return. A treasury bill pays roughly that with no tenants and no roof. Straight cash payback on this building is 22.8 years. That is the honest number, and it is not good. The case for doing it anyway lives in two lines you do not see in the bank account. In year one, $15,960 of your payments went to principal rather than interest, and your tenants funded all of it. By year 8, that figure is over $24,000 a year. And depreciation on the $1,150,000 of improvement value gives you a $41,800 annual paper deduction against $26,000 of real income. On paper, this building loses money while your bank balance grows. But here is what the tax pitch almost always leaves out. If your household income is above $150,000 and neither you nor your spouse qualifies as a real estate professional, those paper losses are suspended. They do not offset your salary. They sit on a form until you sell. And when you sell, the depreciation you claimed gets recaptured at up to 25%, so a portion of the shelter was a loan from the government rather than a gift. Total honest first-year return, counting cash and principal, is about 7%. That is the ceiling on a well-run version of this deal, which raises the obvious question of what the badly run version looks like. It usually dies in year 7, on a date that was printed in the loan documents all along. Small multifamily debt is not a 30-year fixed mortgage. It is a 25-year amortization with a 5, 7, or 10-year term, and a balloon at the end. At year 7, your balance is roughly $856,000, and the whole thing comes due at once. Now the appraiser returns. If cap rates in your submarket moved from 7.6 to 9.4 and your income did not grow, your building is worth $1,148,000 instead of $1,420,000. At 75% of that, the new loan is $861,000 and you barely make it. Miss by a little and you are writing a $140,000 check to keep a building you already own. That is the number that takes people out. Insurance is the second killer, and it moves faster than anything else. A renewal notice going from $21,800 to $39,400 is common now in Texas, Florida, and increasingly the Gulf side of Louisiana. That single letter eats 67% of your cash flow. It also cuts $231,000 off your building's value, because value is income divided by a cap rate, and your income just fell. Third is deferred capital work, which is a slow death and the most voluntary one. You skip the $126,000 roof for 3 years because cash is thin. Water finds 4 units, then the drywall, then the framing, then the mold remediation quote arrives at $47,000. Now you have both bills and 2 units offline. Fourth is a legal environment you did not read before you bought. In some jurisdictions, a non-paying tenant takes 11 weeks to remove, and in others, 11 months. An eviction that runs $14,000 all in, counting attorney, lost rent, and the condition of the unit afterward, is not rare. It is Tuesday. So the answer to whether any of this is worth it depends entirely on which person is asking. If you want income this year, buy something else. A 4.4% cash return with 3 a.m. phone calls attached is a bad trade against almost any passive alternative. If you want an asset that a stranger buys for you over 25 years while inflation quietly reprices the rents upward, this is one of the very few vehicles that does it. The people who win at this share 4 habits. They keep 12 months of debt service in cash and never spend it. They underwrite insurance and property taxes at what the numbers will be after closing, not what the seller pays now. They refinance 2 years before the balloon rather than 2 months before. And they treat $300 per unit per year in reserves as a bill from the building itself. The people who lose share one habit. They bought the rent roll and ignored the loan's expiration date. 24 units in a market you can drive to with $600,000 in cash and a real reserve behind it is a business. The same building with $240,000 down and an optimistic spreadsheet is a countdown. $91 a unit a month is what patience actually pays. Decide if you can wait.